Welcome back to the Block Analyst, where we break down crypto markets with clean data and zero hype. Before we dive in, a quick disclaimer. Nothing in this video is financial advice. We're here to analyze markets, policies, and narratives, not to tell you what to buy or sell. Always do your own research and manage your risk responsibly. Today's episode is a big one. We're looking at the heated clash between Coinbase and traditional banks over stablecoins. Banks are warning of a potential $6 trillion exodus of deposits if stablecoins take off. Coinbase calls that claim a myth. So who's right? And what does this mean for the future of crypto and finance? Let's break it down. According to a report by DL News, major banks and financial lobby groups are raising alarms about stablecoins. They argue that if stablecoins become widely adopted, depositors could move massive amounts of money, up to $6 trillion, out of the banking system. The fear is that this deposit flight would weaken banks' ability to lend, disrupt the financial system, and concentrate too much liquidity into crypto-based assets. But Coinbase is firing back. Their policy chief says this is a false narrative. Basically, banks are exaggerating risks to protect their turf. Let's unpack Coinbase's side first. They argue that stablecoins aren't being used as savings accounts. Instead, they're tools for payments, settlements, and cross-border transfers. If stablecoins were really pulling deposits away from banks, we'd see banks raising interest rates to compete. But instead, some banks are holding huge amounts of reserves with the Federal Reserve. That suggests they're not struggling for liquidity. Finally, Coinbase points to the actual size of the market. The global stablecoin supply is about $290 billion. That's not small, but it's nowhere near the multi-trillion-dollar threat banks are describing. In short, Coinbase says stablecoins are complements, not competitors to banks. Now, the bank's argument. Groups like the Bank Policy Institute warned that new legislation, specifically the Genius Act, has loopholes. These could allow stablecoin issuers or platforms to offer yield-like products, making stablecoins look like interest-bearing accounts. If that happens, people might move their money out of traditional banks and into stablecoin platforms. The fear is that this could shrink banks' deposit bases, limit their ability to make loans, and create systemic risks if too much liquidity shifts outside the regulated banking system. From their perspective, stablecoins aren't just a payment tool, they could become direct competitors to bank deposits. This whole debate ties back to the Genius Act, which is the U.S. law now regulating stablecoins. Key requirements include stablecoins must be 100% backed by cash or short-term U.S. Treasuries. Issuers must publish monthly disclosures about reserves. Anti-money laundering and compliance rules are strict. But here's the controversy. While the law tries to keep stablecoins safe and transparent, some analysts argue it leaves space for platforms to provide yield-like incentives indirectly. That's what banks are pointing to. They see it as unfair competition. So why this intense clash? Let's step back and look at the bigger picture. Banks see stablecoins as disruptive tech. Stablecoins can move money faster, cheaper, and globally, no intermediaries. That threatens banks' monopoly over payments and deposits. Coinbase sees opportunity. For Coinbase, stablecoins are a growth engine. They want stablecoins integrated into DeFi, payments, even everyday transactions. If adoption grows, so does their role as a gatekeeper. Regulatory tug-of-war. Banks have deep political connections and will push regulators to limit what stablecoins can do. Meanwhile, Coinbase is framing banks' warnings as fear tactics, trying to shape public opinion and policy in their favor. Here are three possible outcomes from this fight. Scenario A, banks win the narrative. Regulators side with banks, tightening rules around stablecoins to prevent them from competing with deposits. This slows adoption. Scenario B, compromise. Stablecoins remain strictly regulated but are allowed to grow in payments and settlements. Banks adapt by offering tokenized dollars of their own. Or, Scenario C, stablecoins break through. If adoption outpaces regulation, we could see stablecoins becoming a core pillar of global finance, forcing banks to innovate or lose relevance. Banks warn of a $6 trillion threat. Coinbase dismisses it as a myth, pointing to current usage and market size. The real battle is about control of money. Who issues it, who benefits from it, and who regulates it? So, is this really about protecting depositors, or is it about protecting banks' business models? That's the billion-dollar or maybe trillion-dollar question. Drop your thoughts in the comments. Do you think stablecoins could one day replace bank deposits, or will they remain just a payments tool? If you found this breakdown useful, don't forget to like, subscribe, and hit the bell. More in-depth, data-driven crypto insights are coming up right here on the Block Analyst. And once again, this is analysis, not financial advice. Stay smart, stay informed.